2022. And thank you to all of our registrants and attendees who are participating today in our webinar. My name is Brooke Heffington, Managing Director for Real Assets Advisor. We curate news and publication educational content for real assets and alternative investments. Today's webinar, 1031 End of Year Report, is co-sponsored by Real Assets Advisor and the Alternative and Direct Investment Securities Association, ADISA. Let's move on with our agenda today. We will be hearing from panelists, Taylor Garrett, Mountain Dell Consulting. He'll be presenting today. We also will be hearing from 10-year veteran and Executive Director of ADISA, John Harrison. John will be providing an update on tax and budget timelines following Taylor's presentation. We will have a Q&A session following the webinar today. Please feel free to utilize the Q&A tool on your screen as we will be fielding those questions, and we certainly will be answering those toward the end of the webinar before we conclude. Additionally, we will have 2 polling questions, which will begin at this time. And then I'll turn it over to John. We'll have a wrap up at the end. Please let us know if you have any questions going forward. So I'm going to launch the poll. So everyone get ready, get your screen, pay attention, get off your email. Time for a poll. Here we go. All right, let's launch the first polling question. What is your estimate per the amount of capital raised for 2022 for 1031 exchanges? Will that be 5 billion or less, around 6 billion, or 7 billion or more? Second question, 2021 full cycle activity was significant at approximately 2.1 billion. What is your prediction for 2022? 1.2 billion was the number in 2020. 1.2 billion or less, around 1.8 billion, 2 billion or more. Please make your selections. All right, ending the poll. I'm going to share the results. Taylor and John, can you see the results? I certainly want.
That's 2 billion or more. Okay, that full cycle question, I was curious. That's great. Thank you.
Great question. And those responses came in really quickly. Thank you so much. I'm going to stop sharing at this time. And let's move on. John Harrison, Executive Director of ADISA. I'm going to be turning over to you now. Thank you.
Thank you so much, Brooke. It's great to see everyone today. It's our pleasure to have Taylor Garrett, who you normally see at ADISA events, give a presentation at the beginning, which tells everybody everything you want to know about 1031 results. So we're going to have that for the full year of 2021. Those numbers are hot off the press. So Taylor, let me turn it over to you, and thank you again for all your good work at Mountain Dell and everything you do for ADISA.
Thanks for having me. I really appreciate it, Brooke and John. I'm excited to go over the numbers. What a banner year it was. It was crazy to see how it all kind of came down, especially towards the end. There was a lot of equity that's being raised, but we're excited to be able to go over this data and see if anybody has any other input or questions as we go along. For those of you that are aware, I mean, last year was a pretty phenomenal year. We broke through every potential record that we had as far as equity raised. I think presenting back in October, it was going to be something around 5, maybe 6 billion is where we thought we were going to get. We surpassed that by a pretty heavy amount. Go to the next slide. Great. So this will show you the number of active programs that we had. 265 active programs, or 42 sponsors, or 2, which we'll talk about a little bit later, that aren't captured quite the same. That actually takes this number closer to 8 billion, but significant increase. We moved from 170 programs in the 2 previous years, 130, 126. When you're adding 100 programs and the size of programs were bigger, as we'll show a little bit later, it obviously allowed for a significant amount of equity to move. Our biggest year ever was 3.65 that was done back in 2006. So to get up to these numbers obviously changed the dynamic quite a bit. This shows you the different sponsors, who the biggest sponsors are, the top 10, obviously in the top left, Inland, Aries, formerly known as Black Creek Group, Capital Square, moved up, Cantor Fitzgerald, Pasco. A lot of those groups have been there for a long time. Exchange Right, Madison Capital, Carter, those are newer groups to the kind of the top, and Blue Rock and RK Properties round off your top 10. But, you know, not a lot of new players necessarily involved in the space from what we've seen in the past, but it definitely, some of the bigger groups moved the needle quite a bit and moved to where we could hit that higher number at the 7.4. Go to the next slide. So this shows the asset type. So this is the equity that was raised per asset type from a pie chart perspective. Multifamily was obviously a significant part of that, always has been. Retail was a big part. Industrial really, you know, as Black Creek or Aries kind of moved up, they do a lot of industrial deals, some other groups that do them as well, but they had some massive deals that came out and moved pretty quickly. And so we saw industrial really move up from you know, something that's closer to maybe the 5 or 6% range, 4, 5, 6% range, to being almost 18% of the marketplace last year. The next slide. And this will kind of play all of it out. So, you know, multifamily has always been just traditional multifamily, as we would think of it, always kind of been around 50%. Usually we saw more student housing being a bigger part of the overall kind of portfolio, and what was going to be raised. Manufactured housing actually jumped up this year from out of nowhere, really, to be almost 3.6% of the marketplace, just over that. Really, we saw no hospitality. We saw a little bit last year, but really since COVID started, hospitality deals haven't been coming out at all. Energy deals that come out, other more kind of land deals that we're seeing that were being done, but we haven't seen some of those for a while. Senior housing definitely moved up. Last year really wasn't much of the overall marketplace, but has moved up quite a bit. Medical office has always kind of been around that 2 or 3% market. Office moved up a little bit more than what we've seen, but again, a lot of that's kind of single tenant type of products, not necessarily multi-tenant office that maybe some of us are familiar with. And self-storage has been a phenomenal asset. People have really liked that. When those deals come out, they've been able to move really quickly. All right, next slide. This kind of shows the states. Excited to see the Utah property finally got done last year. It's been a long time, so thank you. But almost every state got some type of transactional volume done last year. Only a handful that didn't. I think there were 4 or 5 that didn't have any transactions done. But for the most part, you saw at least one property done in almost every state. Clearly, Texas, Florida, Georgia, the Carolinas, Illinois, these are some of the areas where we're just seeing tremendous amount of product. That tax-free kind of state with Texas and Florida has been something that's been really sought after, and really good growth markets for most of the multifamily. That's where we're seeing most of the action being done. But we saw a lot more in California this year. In Nevada, we saw a lot more. So these are states we haven't traditionally seen quite as many done at, but there's just a lot of transactional volume done last year. So we're probably going to see them in every state like we have. Next slide. So this shows, as of December 31st, what's currently available in the market. So this isn't a year-long pie chart. This is just, hey, what was available at the end of the year. This is the product and programs that were out there. Multifamily's down a little bit. That's mostly because deals are selling out so quickly. But it's, you know, it's scattered around a lot of different products. A big self-storage product that came out, jumped up that percentage of the marketplace because of that, but nothing that's really outside of what we'll typically see on a snapshot basis of where the market's at. Next slide. So I'll spend some time on this slide. I think it's important to kind of understand where we were, where we're currently at, where yields are at, where loan to values are at. This is the equity available, 1.3 billion of current equity available as of December 31st. You know, based on the run rate, the last 2 weeks of the year last year, I think we raised $518 million of equity that was raised in the last 2 weeks. So in theory, that's, you know, could be a month and a half, 6 weeks worth of product available type scenario, but that's a lot of product has come out since then. So I think that number is going to jump up a little bit. Average first year return, including all investment types, including the 0% leverage type of deals, 4.5%. Clearly, that's come down significantly over the last couple of years as cap rates and interest rates have decreased. Available offerings, 61 sponsors that have a deal out at the end of the year were 27 different sponsors of the 42 that had deals out last year. And then so multifamily, again, 46% 2019, 51% 2020. Didn't move a lot around that. And I don't think we'll ever really see that move a lot. I guess never say never, but currently always think that multifamily is going to be generally about half of the market. Retail, most of that retail is single tenant retail. You're not going to see a lot of multi-tenant retail in that, although we are seeing, more people work and look at that as a potential diversification for investors that they're kind of seeking as most of the products that they're being able to look at is these different multifamily and retail products are out there. Industrial, there's a few groups that are open. Okay. Industrial, as I said, up to 18%. Years before, is it 6.5%? So kind of a nominal amount of the industry, not nominal, but a smaller amount of the industry from where they have been previously have really jumped up. And that's because of a couple of big sponsors that are bringing out those products pretty consistently. So I think that number is probably here to stay. I think there's a lot of interest in industrial. And so as that product comes out, it moves pretty quickly. And again, I think what a lot of investors are looking for is a way to diversify, not just inside of multifamily or retail, but so industrial and even self-storage seem to be the two plays where people are using that a lot to be able to diversify. Self-storage, I think if we could get more self-storage, there'd be more demand for it. I just think it's a matter of product shortage, challenging of being able to cobble together portfolios to make them big enough to be able to come to the space and have some semblance of a shelf life. A lot of moving parts. If you're buying $5 or $10 million assets, you probably have to buy 10 of those at a minimum to be able to bring out a portfolio that makes sense in this market environment. Manufactured housing. You can see those NA, the 2 years previously, they just weren't being done, and they've taken off. The sponsors that are working on that, or sponsor that's working on that, seem to have a lot of success in raising capital in that as a diversification for investors. Really, some senior housing, again, it's been a little bit mixed just because of the COVID has had some challenges with it, but better buys, better opportunities with that, and probably some okay upside on that because of where the market is there. Student housing, we really just haven't seen much of that, but I think that's going to change. I think we'll start seeing most colleges are crushing it. Most of the student housing in separate states where they really shut it down did pretty well during the pandemic, and so I think that's probably going to ramp back up. I would expect to see that more in the 4 or 5% for this next year. I can go to the next slide. All right, so market summary, 7.44 billion of what we show. There are two sponsors that we can't get. We don't get the numbers from them as consistently, so we don't share them on a consistent basis. But we do want to add them in because they're prominent sponsors and they do a decent amount of equity. So add that 573 million. The real number is over 8 billion. There's a couple other groups that have done kind of one-off 1031s in the broker-dealer space. More tenant and common type transactions. Not everything's perfectly accounted for here, but absolutely, I say with confidence, we raised over $8 billion as an industry last year. So over double what the highest year was in 2006, and obviously over double of 2019 and 20, where they were kind of in the mid threes as well. So significant year for the marketplace. 61 total available offerings, 204 offerings closed at some time last year. So that money could have been, there could have been equity available in 2020 that closed in 2021. That would count as a 2021 close. And deals that had any equity still left in 2021 and moved over to 2022 would not count in that. But 204 offerings that closed. Most of those are 506B. We've kind of gone backwards. I thought 506C were kind of moving in a direction where they were going to have more of the market, but really from a percentage basis, still 506B is kind of crept up, doing more percentage than they were previously. Mostly DST, that's where the financing is. That's where most of the deals are. The tenant and common deals are traditionally deals that have, a few more moving parts that aren't really structured well for a DST. And then some other products are more one-off. So these are some important stats here. Average days on market, 107. The median was 69 in 2021. The last 2 weeks of the year was 60 days. So just money was moving quickly towards the end. A lot of full cycle activity and just people getting their transactions in. Average days on market in 2020 was obviously significantly higher. So we've really seen an adjustment there. Next slide. And this will show you that last quarter, we were about at 5 billion, coming up on 5 billion when we kind of had Adisa and discussing these things, and then it just took off. We did 50% more in the last quarter. If we went from 5 billion up to essentially 8 billion, if you look at that, you know, to do, what is that, 60+% of the market in that last quarter, I think everyone is pretty busy. We saw it, we felt it. You know, sponsors were busy, QIs were busy, lenders were busy, reps were busy. I think it was kind of a challenging time for everyone in a certain regard, but definitely a lot of demand for it and just probably not enough product on the shelf. Go to the last slide. So I'll spend a little bit of time here because there's a few talking points that I think are important for all of us to understand. You know, last year we did 8 billion. At the start of the year, it seemed like things were getting pretty busy. I thought we were going to do 6 billion. So, you know, I was way off. But that's a significant number. I think as someone who's been around the industry now for just over 18 years, I mean, I like to think that we've matured a lot. The products that we're coming out with work really well for the investor type, for what broker dealers want for their investors, what investors are looking for. Kind of fewer moving parts for most of the deals that are coming out. And I think my opinion is that the industry shined during the pandemic. If we would have been doing a lot of heavy multi-tenant office and multi-tenant retail like we were back in the early 2000s, we'd be having a very different conversation where we're at today. Instead, the industry is really focused on what it's been trying to do and understanding kind of the risk-adjusted return and what a DST requires from a structuring standpoint. And apartments and net lease, just, you know, as the two main products that are being done, did phenomenally well. And I think because of that, I think this industry got, you know, some gold stars, I guess you would say. And we're having a lot more conversations with some very meaningful groups on the broker dealer side. On the sponsor side, a lot of people are looking at this for bringing out, you know, good, consistent, middle of the road type of product. And that's what investors are looking for. And I think that's what we're giving them. And so it's a good investment for that. It allows for, you know, a fully baked deal. Most of the time, the financing's in place. They're taking down the property before it comes to market. That bodes well for investors that are coming out of an exchange and have that, you know, that challenge of 45 days and making a lot of decisions. These are fully baked deals that have been vetted by, you know, broker dealers, attorneys, third-party due diligence groups, the sponsor, obviously their team, managing broker dealers, the retail rep. I mean, this is reviewed by a lot of people before it gets to that end investor. And with the financing in place, I think it's a good model and a good way to diversify someone's investment. If they have $1 million, they can go into 4 or 5 or 6 different deals if they want to create their own diversification. And I think it's caught on. And I think a lot of people are seeing this as a very viable, you know, passive investment for 1031s now. So I think that's a big reason for it. I'm excited for it. I feel like the industry is maturing and we're seeing a lot of success from that. Average equity raise per week, 154 million. Obviously, it's simple to say it's over double where it was last year because of how much was being raised. We had 8.65 weeks of product available on an annualized basis, but if you take how much money was raised in the last 2 weeks, it's closer to six weeks of available product, or a month and a half worth of product available. Average deal size, I think this is important to note, and also something great about DSTs versus the TICs of old was the average equity raise was 10.2 million in 2015. In 2019, it was 20 million. Last year was 28 million. I mean, we saw some massive deals come out last year. Multiple 9-figure deals, hundreds of millions. We saw a $350+ million deal that came out into the marketplace. I mean, that's not something we were able to do. Obviously, with TIC deals, if you only have 35 investors, you You have a $35 million equity raise, each investor has to put in $1 million. With DSTs, you can put $100,000 into, an institutional quality, multi-$100 million, $200 million asset. You can put $100,000 in. That's really what these investors are looking for. They get to diversify by geographic region. They get to diversify by asset type, by vintage, and it just makes for a good investment vehicle for that. But we've really seen that move up, and really it's trying to create some semblance of shelf life for these broker dealers that are, overworked, to say nothing less than that, with the amount of deals that they're having to see and deals moving very quickly. It makes it challenging in a lot of ways, to be able to have that kind of the equity volume that your reps need, and be able to, satisfy their requirements and their needs for investors. Average days on market, it didn't move as much as I thought. 127 days in 2015, 182 in 2019. Last year, 107, but really in the last 2 months of the year, it was under 70 days. Average deal launches, deals 100% fully closed within 70 days. And a lot of times, you're waiting on your last ticket for a week or two, or last $1 million in a deal for a few weeks. I mean, to have 90% of the equity raise was probably closer to 50 days, right? On a lot of these deals, which is quick, which is fast. Market demand is strong. Supply has kind of caught up. I think there's still a lot of demand for more supply, but clearly sponsors had to work hard and increase their acquisitions team and their team to be able to bring out the amount of equity that had to be brought out to get to that $8 billion amount. But we are seeing lower projected returns than where we've seen in the past. I'm not sure what's going to happen with interest rates. Sounds like they're going up. So we'll see if cap rates follow them, or if they still stay a little bit lower. It'll be an interesting time for investors as they're considering, different tax environment, higher taxes on long-term gains, paying their taxes, cash flows a little bit lower. I think people are really looking for markets where they feel like they can get outsized growth to take advantage of maybe an inflationary environment where you're able to push rents on a consistent basis to be able to increase the value of that to offset any of that cap rate decompression. So yeah, full cycle. I asked for that question on what kind of anticipated full cycle equity. I wanted to get those answers from sponsors and from reps and from everybody. What I'm hearing, kind of the pulse on the street, is that 2.1 billion last year. I think it's going to be more this year. And again, 2.1 billion, that's 25% of the market. Not all of that recycled back into DSTs. Maybe let's say 70% of that's usually a pretty good number to think of. 70% of that, 1.4 billion kind of goes full cycle and goes back into those deals or other deals. That's still a lot, but there was a lot of fresh capital that came into the space from new investors that hadn't otherwise gone into, or weren't coming out of a DST going into this. But if we see, let's say 2.5 billion of full cycle activity, and 1.8, 1.9 billion of that goes back into DSTs, on top of other investors that are coming into this, I think we can absolutely raise 7 billion. I think we could hit 9 billion. If the market adjusts a lot, there's always, possibility it could be lower than that. But with some of the sponsors and broker dealers that are here and maybe entering the space, and the level of interest in 1031 investments, there's a possibility to hit 10 billion. So I think I wouldn't, shock's not the right word. I would think we'd at least hit 7 billion, and I think we could be north of that for sure. Again, we're involved a lot with talking to new sponsors that are looking to enter the space. And I think from our conversations that absolutely there's a possibility to see some really, really strong sponsors looking to enter the space, which is exciting as the industry continues to mature. I think that in the end, a challenge for any investor is, as I say this a lot on this presentation, their challenge is they're excited. They just sold their investment. They just sold their fourplex or their beach house or their farm at a price they never thought they'd probably get. But fast forward, you have 45 days to make a decision, and you're investing in the same market environment that you just came out of. And the reason you sold for such a good price was because of that. And I think, that's sometimes a challenge for certain investors, but I think you know, with the ability to diversify and say, hey, I sold a fourplex here in Utah and Salt Lake. I can go buy another fourplex down the road, and it doesn't really change the dynamic of what my investment is. But if I can go invest in something in Florida and Texas and, you know, Chicago and you know, California or Arizona or something like that, then it allows me some great diversification and good opportunity to, you know, get to where I'm going as far as, you know, maybe a retirement stage and being able to spend more time not having to work on it manually. I think this is something that we're gonna see more. I think last year there's some transactions people maybe decided to pay their taxes. This year, my understanding, and John, correct me if I'm wrong, is that we're going to see some you know, adjustments to long-term gains and being able to move up. And if that happens, I think they'll put even more pressure on people wanting to do 1031s or opportunity zones or a combination of it. And so I think, you know, that will just put added pressure to do even more equity down the road. But I guess with that, I'll turn it over to you, John. If there's any questions, happy to answer them. But thanks, Brooke, so much. Sorry, my malfunction with the Apple computer. It wasn't as simple as it usually is for me, but thank you.
You did great. Thank you. John?
Thank you, Taylor, very much. Thanks, Brooke. I'm to cover the L&R update, reg. What's going on in DC as around 1031s? Well, we had a major victory. Many associations together and the real estate roundtable sort of heading up a coalition. And I personally visited probably over 30 members of Congress and a lot of activity. All that's to say, we dodged a bullet last year. Now, what about this year? Well, first of all, I have to cover just a bit about the budget process. I'll try not to get into the weeds because I could show more slides than Taylor on the US budget process. When you talk about a $6+ trillion budget, the world's largest expenditure, and it has a process that makes sausage making look clean and easy. It is a giant mess. Right now we're in FY22. As most of you know, the government fiscal year starts October 1st and goes through September 30th. And we are somewhere in the middle of that, close to the middle. And we do not have a budget. We are operating under continuing resolution, which is basically the legislators saying, let's just keep the government open as is and just keep functioning. The current resolution expires, I think, February 18th, and they will probably just vote another one. President Biden is not giving his State of the Union address until sometime in March. So if that's the case, that usually kicks off the White House budget process, and they just throw a draft budget out to Congress from that point. So there'll be no activity until March. Now, we're in FY22, so it can possibly go the whole year without a budget. Now, let me predicate something. I know Larry Sullivan, when he used to give this same thing, would take a look at the time and the day and say, as of today, this is what it looks like. Because at any given point, somebody can derail the process or Congress can do what it chooses to do. So all that said, I don't particularly think we're going to have any activity on FY22, which obviously goes to September, that has to do with 1031. However, something could happen, but otherwise it's FY23. That process normally is supposed to start this month for FY23, which begins October of 21. The process that begins this month should wrap up sometime in May, if that's the way it's supposed to work. Well, it never works that way. So the way it's supposed to work is kind of senseless. What we have now is a situation where there's an election year, which will bring added pressure, not wanting to take sides or anything, but the Democratic side of the legislators typically want to spend more money than the Republicans, and therefore they should be interested in also raising revenue. Now, what does that mean for us? That means that we will have two forces. One is the actual economic force, and the other is the optics of reelection. Remember, the government is not in the business of governing. The government is in the business of getting reelected. So that's the primary thing we're looking at, and that's what we fought last year. We fought the optics. Now, because once we go in to educate members of Congress, it's pretty simple. Here are the numbers. Let's say this was the numbers I used last year. 50 billion in GDP per year is generated from 1031 exchanges. Approximately 16% of the commercial real estate activity involves a 1031 exchange. So in addition to that 50 billion, you're talking about, and this was using the data we used last year, about 500,000 jobs. So that's on the plus side of 1031s. What's on the minus side? Well, the minus side, if you got rid of 1031s, the government would gain, and this is using the Biden administration's own numbers, the government would gain about 2 billion. Well, hell, that's less than Taylor's full cycle for a year. $2 billion, that's a rounding error in the government budget. So once you made that math clear, it's a no-brainer. Now, the optics, that's the other thing. We have the optics of worrying about somehow, somewhere, this is all about rich people and we need to soak it to the rich. Well, we have to defeat that. And we did a pretty good job last year. I think all of the associations combined did a lot of work to show that 1031s, when that velocity is generated, all kinds of good things happen. You've got painters that need to be called and you've got this, that, and all kinds of activity happens. So it's not about the soak the rich. So if we can keep that up, then we're under the radar. FY22, no problem. Probably FY23, no problem, because here's the pressure though that happens in FY23 election year. The Congress might want to do things and leave the next Congress with a bit of a problem or a rush to do things in terms of election year optics. So those are the risks. So here's what we're doing about that. We're updating the numbers I just gave you, which was the 50 billion and the $500,000 jobs. Well, that looks like it's going to be, Ernst & Young is working and crunching the numbers, but our prelim data show that for 2021, the activity was 70 billion. This is part of what is generated for the country as a whole by what Taylor is talking about. So we've got 70 billion per year effect on the economy on one side. Now the job count with that goes up to close to 700K. Looks pretty linear so far, so I'm happy about that. So that's a huge plus. We don't know if they're going to adjust the revenue that the government would gain if 1031s disappeared, but given it was, even if it's twice what it was in the last estimate, from 2 billion a year to 4 billion, that's still chump change in the US government. So it doesn't make any sense. So our only risk is optics for in the election year. And I don't see that as really a big problem. Now, where are our points of exposure? The points of exposure are during the summer, probably is when they'll be working on the FY23 budget, given everything's delayed. The State of the Union's not till March. Last year, the budget wasn't put out there till June on FY22, and it didn't go anywhere. So I'm thinking that we're looking at a summer schedule again of some kind of budget process really kicking off for FY23. Now, what the other risk is that it doesn't go through a regular budget. It ends up going on an omnibus bill or continuing a resolution. Some appropriations is put in there. Tax law can get thrown in at any time, but I think it's highly unlikely. Hill Staffer, our DC guys, have a person really that specializes in this budget process and where are the chinks in the armor and that kind of thing. So we've got an eye on it. The headline, don't think anything bad's going to happen anytime soon. Now, and we are working to update the numbers to have some arrows in our quiver to make sure we can target and adjust. I want to thank all of you who have been involved with our 1031 arguments with members of Congress. I know we've had a number of ADISA members appear last year. And just so you know that the Congress is in no hurry to get rid of Zoom calls. They raise more money on Zoom calls than they ever thought about raising by meeting and greeting people with the old-fashioned way. So it's been a boon for the congressional fundraising. And I'm happy to answer. Let me just look and see if we have any questions regarding so there, Taylor, we can either answer any of these.
Do you want to start with the legitimate, the legislative update on op zones? I know this is kind of focused on 1031s, but I guess they rhyme. If you have anything different there to be discussed.
I think the only thing I would add about opportunity zones and that I think the last report we did in the fall had a pretty good uptick in opportunity zones. At the one we presented at the conference, I think the data Stanger has those data as well. They're in a number of places, also on the ADISA website if you look at conference presentations. But remember that the opportunity zone, unless you it's a calendar limited. So the longer we wait on it, unless something happens and it's re-upped or reformulated, the longer you wait to do it, the less tax effect you will reap. So there is that situation. I don't know what the sweet spot is. I haven't seen the math on that. So I can only tell you that there's a limited window where that can work. And I think, Taylor, normally if somebody has a huge amount of capital gain and they're not interested in doing the a 1031 exchange, then certainly opportunity zones presents an opportunity to shield that gain.
Yeah, let me just repeat the question for those who are not looking at the Q&A. The question from Joseph Bench is, how much does availability of opportunity zones impact demand for 1031 exchanges? So thank you, John, for jumping in, answering that. Taylor, I'll let you respond.
Yeah, I mean, I'll couple that with Ray Singleton's question. How much equity you think went into op zones? It could have gone into total DST equity numbers in 2021. I can answer this a few different ways. One is I don't know, but two is from what I could tell, initially it seemed like opportunity zones were a great use if someone couldn't find a 1031 DST or their own 1031 or blew it, somehow took the money, didn't realize they had to send it to a QI or got past for 45 days and a deal had some moving parts, it didn't work out for whatever. But I mean, I will say a few years ago, I didn't think opportunity zones would be as significant of interest in the space, but I've seen some of the numbers on DIY from some of the great sponsors in this space and hundreds of others, people that have nothing to do with our space. And there's a lot of money being raised in opportunity zones. Now, obviously that doesn't have to just come from real estate, and a lot of it is not. People selling their businesses or selling enormous amount of gains in stocks that have happened over the last several years, paintings, whatever it is. If you're selling something, you have a gain. An opportunity zone is a great way to, consider. There's a lot to that, right? This step up in gains that John is alluding to. My understanding is that 10% step up is now passed. So now your benefit is just deferring those gains till 2026, 2027. Paying them in 2027, and the benefit of the growth on the gains during that 10-year hold period, if you hold it, wouldn't have to pay it. So I think we're going to see more and more of it. I didn't think it was as much of a retail space type of investment. I thought it was more of a private wealth type world where that was going to be playing the most. But you have people able to put 50,000 or 100,000 of gains in these things, and I think they're making a lot of sense. So I think op zones are here to stay. I don't know where it's going to go from a legislative standpoint, but I mean, how much could have gone into DSTs that ended up going into opportunity zones? Sorry, Ray, I don't know the answer to that. Maybe $500 million, maybe $1 billion, maybe nothing. I don't know if there were people like, oh, I'm trying to weigh, do I want to do a DST or do I want to do an op zone? I'm going to do an op zone and nothing and do a DST. Maybe people split some of that, but yeah, it's a good question. I think I love that, you know, AI Insight, iCapital does a good job of gathering some of those statistics and Stanger and everybody, but it's not as readily available. So, but Adis has done a great job of getting those numbers and being able to post those. But it's a drop compared to all the stuff not being done. Different than DSTs, where most 1031 syndications are being done in this space because of the securities requirement. Opportunity zones are being done everywhere, and it may or may not be having to do anything with this space.
Let's go to Jim S. had a question. You know, what are the most challenging aspects for sponsors in these days? I know we've talked about that, and a few things he alluded to is finding property in the first place, an issue, finding investors, finding bridge capital acquired properties prior to syndication. Talk to us a little bit about that, Taylor.
Yeah, I work with sponsors all day, every day, and as well as kind of reps and BDs. So I feel like I have a pretty good pulse on this. I mean, a lot of it's just, it's volume. I mean, you know, if deals are coming out and closing really quickly, it's acquisitions, it's financing's crazy right now. I mean, you could put something under contract today and it could swing 50 basis points on interest rates, 30 basis points in interest rates, which really affects the underlying, you know, cash flow and return profile for that investment just from putting under contract to closing. So I think that's an unknown right now. I think they've been pretty low interest rates for a while. So you kind of base cap rates and what you can do with that. We're absolutely seeing cash flows in the threes now. You know, I used to say, oh, if you're a 5 handle, you know, this is several years ago, if you're a 5 handle, it's different. Oh, if it's a 4 handle. Now we're down to the 3 handles, and that's, you know, so investors and reps and BDs and everyone's having to make decisions of, you know, what's best for the investor. And I think it's an important discussion to have. Some investors don't want to pay tax. You know, they'd rather do anything than pay taxes, and some of them may make sense to pay. It just depends on their situation, obviously. But I think just bandwidth, having the right team. How much do you, you know, hire a big corporation to be able to do this stuff? Is this going to be long-term? Is this a finite amount of time? Do you work with what you have? And it's just finding good real estate. We're competing because this is institutional real estate now. I mean, these are great assets. These are $100 million assets. So you're competing against the biggest for some of these assets. Absolutely. And so, you know, some of them have a different return profile or a different way that they're looking at the real estate that they're buying. And so if sponsors are trying to compete for that product and going up against some of those bigger groups, it's just, you know, it's complicated. So there's a lot. There's going from 3.5 billion to 8 billion in 1 year there's a lot. There's a lot of transactions. There's a lot of, and I don't know if everyone's read. For me personally, I'm seeing that the world is no longer a just-in-time world, and getting stuff turned around in 24 hours is a big feat. If you're getting 50 sets of subdocs or 75 sets of subdocs or 10 sets of subdocs, where, you know, you're used to getting 1 or 2 a day, and now all of a sudden it's tripled, quadrupled, 10x. That, you know, it puts a lot of pressure on groups, and how do you hire and train fast enough to be able to handle that? I think all those things are challenges for all of us, not just sponsors, but every reps and broker dealers and due diligence departments and sponsors and attorneys, and lenders, and managing broker dealers. So,
good answer. Let's go to Joseph Bench's question. I'm sorry, Craig Cooper. Go ahead, John. Did you want to add something?
Yeah, the question is, what about step up in basis? And that issue is a huge one, and it's being tackled and managed by forces a lot bigger than just the alt space. So you're talking chamber, AARP, huge interest involved in the stepped up basis. And I personally don't think the optics are worth the risk that folks, members of Congress, MOCs would face with that issue. So I know it's talked about, and certainly the numbers would be a whole lot more than the $2 billion for the Treasury. However, our whole system, that our current tax structure is sort of revolves around that in terms of inherited wealth and inherited property and all that. And so I don't know that they're going to be able to move that. Just theoretically, limits or something like that might be an optic that could play in, but just in terms of eliminating it from our usual tax strategies, I don't think that's going to happen. Again, remember, you have to think short term. Do not think like a financier. Nothing to do with long-term good benefit. No. This is all about, can I get reelected next cycle? That's what you have to think through and understand. So I hope that a little bit of a dodge on that one, but I don't see it as a huge risk at this point.
Brooke, there's some questions. Are you okay if I just hammer through some of these? Okay, so Brandon, Radica, we talked about this a little bit. I mean, if interest rates rise 2 or 3 times in 2022, so if we're up at 6% interest rates or 4% interest rates or 5 or whatever, that's going to impact the space 100%. It's going to impact values that people are selling at. It would absolutely slow down volume because I just think the value that people could pay for things would decrease it. So, I'm not an economist, and I don't know if anyone can call themselves an economist when I don't think anyone learned from Adam Smith what you do when trillions of dollars gets put into the economy, and printed and this kind of inflation. So if someone has a crystal ball on that, let me know. I'll invest with you and give you everything I have. Jerry Garcia, great question. I actually meant to hit on this, but I felt like I was running a bit out of time. 2022 was absolutely the rise of 721 exchanges. And a big part, 2021. And a big part of that was we were all concerned that 1031s were going away, as we should have been. And John and his crew and a lot of people were spending a lot of time making sure that didn't happen. But 721s, a lot of money got raised into programs that have the opportunity to go into a 721. And some of those programs require you going into a 721, and some of them are optional to go into a 721. And that is, I think there's a lot of benefit for that. The broker dealers that I'm talking to, what they prefer to probably see, from what I can tell, is an option, right? An investor, it can go into a 721 if that makes sense. If you want to get cash out, you can do that. Some blend of it is I think probably preferred. But most sponsors now are baking in some language into their PPM that allows for a 721 exchange for just in case scenarios of 1031s go away. You don't want to sell this because then they're required to pay their taxes. So let's put it into a bigger product. So I don't think that trend's going away. I think some type of optionality in a PPM to do 721 is going to be in most PPMs going forward or sometime in the near future. That's my opinion. I could be wrong. Mike Conso, we'll skip that. John, you're going to talk to him about that offline. It looks like, let's see. It's a lot of spending going on. I agree.
In their mind.
Let's see. How worried about DST market is getting too hot? So Randy, the question is, how worried are you that the DST market is getting too hot and that it will result in much worse investment choices? Last time we saw in mid-2000s, lots of investors lost a lot of money due to DST companies buying too many properties just to keep up with demand. So I will change one word in there because a lot investors lost a lot of money due to tenant in common companies buying too much. These are different investments. I don't disagree with you in a sense that we need to make sure, and all of us need to hold sponsors responsible to still buying really good real estate. I think the good sponsors out there aren't just bringing out deals to bring out deals. They're making sure that they're finding assets that they believe in, that they feel like over a 5 to 10 year hold period are going to be a good return profile for those investors. We're not looking for grand slams on these DSTs. We're looking for plain vanilla down the middle of the road type of programs that they're not meant to be 20 plus IRRs. They're meant to be high single digit, mid single digit. Maybe if you're fortunate and cap rates are compressed like that, you're going to get double digit. Some of them crushed it, right? But that's not the intention of what this DST is. It's really meant to be buy good quality real estate that's down the middle of the road, not a lot of moving parts. Apartments, 2008, Lehman Brothers crash, the world was on fire, really because of the financial crisis, the debt freeze and no ability to do transactions. That's what killed the market so much in a lot of ways in real estate. But apartments, most of the apartments that were held and a lot of the net lease that were with credit tenants, they ended up okay, right? I mean, there was a tough time during that time, but we're also buying at 10% less leverage and sometimes 15%. We're buying stuff at 50, 55, maybe 60% leverage for the most part. Back then we were buying it at 70% with tick space. And we were buying things like office buildings where you have one tenant that represented 40% of the building. If they went dark, if they went bankrupt and left, significant tenant improvement dollars, significant leasing commissions had to come up that you weren't prepared for because they still had 10 years left on their lease. We don't have that anymore. You have net lease stuff with, mostly credit quality tenants or strong companies. They have 12 years left on their lease. Good times, bad times, unless something significant happens that, you would hope they'll be able to pay their cash flow. And then apartments, just people need a place to live. For sure, values can go down, but we're in a very different spot than where we were. And we're buying much different stuff than we were back in the mid 2000s. But for sure, we all need to make sure we're holding sponsors accountable and buying good real estate that they feel like can grow and be successful for the long term. Student housing available equity, Lynn. I think we'll see more of it this year. I think I mentioned that in the presentation. I think that'll move from 2% probably to 5 to 7% this year. I think we will see more of that. I think it's outside of a pandemic, which is tough to underwrite for, and different. Now we know which states are more prone to shut down and not. A lot of student housing did just fine and actually excelled in a certain way during the pandemic. So I think that'll be okay. What has been the range of starting distributions with the energy, oil and gas 1031 exchange programs? It's been pretty limited. Oil and gas has been a little bit up and down. I think that's much more of a diversification play, right? So if someone's got $1 million, I don't think they're putting $1 million in oil and gas or even 500,000. I think they're putting maybe 100,000. So I can see that being an interest, but we've seen a lot of ebbs and flows with energy. And so my opinion is we'll never see that be 10% of the market, but I do think we'll see more of that this year. It's gotten better. Larry, do you have any stats on the fee structures of sponsors? They're a trend up or down or staying the same? Larry, that's a good question. We don't track that. We don't get the PPMs at Mountain Dell. I just say in general, they've somewhat stayed the same. I think some costs have been able to come down because deals have been moving pretty quickly for bridge costs and different things. But other than that, we haven't seen a huge trend up or down in that regard. We do see maybe some downward pressure, but not significant. There's still the risk profile for broker dealers and reps and sponsors for putting everything together. There is a time where you got to kind of figure that out. But some of the bigger groups, some different groups are putting different types of fee structures on, whether it's upfront or ongoing and things. But I don't have a great answer for that. I think most of the third-party due diligence groups probably would be your best resource to ask that too, because they really dive into each one of them. How much of the 7.4 billion was rolled from prior DST investments, Levi? So that's 2.1 billion-ish of full cycle equity happened last year. This just a guess, but I would say 70, maybe 80% of that rolled back into DSTs. It really depends on what their experience was in the previous DST, but so I'd say, 1.4, 1.6 billion was probably, of that 8 billion was recycled DST equity back into the space, which we think will be higher this year. I think we have one more question. How do we get the regular updates on Mountain Dell list? So Brian, I guess I'm not trying to make a plug on the question. We send out every 2 weeks, or on the 15th and 1st of the months, we gather the statistics and send it out. The sponsors, we only send those to sponsors, and they sign up for that. And so that's how you can get on that. But if anyone has any questions, our last slide, you can just email questions@mountaindaleconsulting.com. If you want to get a copy of the slides, it looks like a lot of people ask for that. You can shoot me an email. If you send it to questions plural, questions@mountaindaleconsulting.com. I think, I'm pretty sure that's it. Then we can get it. If it's not that, you can send it to Garrett, TGARRETT @mountaindaleconsulting.com, and I'll get it sent over to you.
Or, and I'll give a shameless plug, I have no shame, or you can go to the ADISA event coming up in April, and Taylor will be there giving the latest, greatest update, running in at the last minute with the numbers just for everybody. So if we're in Orlando, if you're worried about your spring break for your kids, just bring them along. We'll be at the Rosen Shingle Creek, which we have been to before, a wonderful property. So that will be April 4th through 6th of this year in Orlando. Sorry about that, Brooke, but
I'm tagging on. You can certainly visit realassетsadvisor.com. We will be posting the webinar as well as ADISA in our resource center, and Mountaindale and Taylor have been gracious enough to provide the data that you have seen on the webinar today, which I know many of you are asking for. Additionally, Real Assets Advisor will be producing a 1031 update that will be available in your March issue. You will certainly hear more from Taylor and product sponsors in the space. So we look forward to their participation. We look forward to you joining our webinar series on a monthly ongoing basis. This is the first of a 12-month series. So please know you will be hearing more from ADISA and Real Assets Advisor in 2022 as we continue to tackle and educate the most important topics in our space and our industry for real assets and alternative investments. And we appreciate all of our participants today. Appreciate your participation in the polling and staying very attentive till the very end. We still have 171 participants on this webinar. So you guys are all rock stars. Amazing year. Thank you, Taylor, for an incredible update. $8 billion is just phenomenal. And those polling questions several months ago did not warrant that. So very, very surprised today.
That's
so
right.
Thank you all for participating. Your questions, again, field those through any of us. Our contacts are available on our websites, and if you don't have them in their emails. So Taylor, John, is there anything you'd like to wrap up or say or conclude before we go?
I've already given my plug, so I'm good.
That's right. Thanks for setting it up. I appreciate it.
We appreciate you so much. It's 3 o'clock, 1 hour. Great job, team. Thank you all.
Thank
you.
See ya.